Unlike a lot of technical analysts out there, I didn't actually spend lots of time cherry picking these examples. I thought of Microsoft because I'm writing this on Microsoft Word, and I thought of Johnson & Johnson because my wife had some baby oil lying around. So those are the reasons why I thought of Microsoft and Johnson & Johnson. There's lots of examples that sort of prove to us that technical analysis may not work as advertised. So here's a monthly chart for Microsoft going all the way back to 2002, early 2002. And chartists frequently tell us that a company has resistance at certain prices and support at certain prices. So resistance represents a ceiling, and when a price hits that ceiling, you should get out and sell it. And a floor represents a time to buy. And the floor then, of course, is when you want to buy because the price is inevitably going up. And so if we look at Microsoft going between 2002 and say 2006, that rule seemed to make sense, right? So you'd get out in the high 20s, and you'd get back in if it hit the low 20s. And so that made sense. And so it was a profitable trade until it wasn't. And here's what I mean when I say it wasn't. Because another principle with technical analysis is that today's resistance is tomorrow's support if that resistance gets broken definitively enough. And no one ever defines what definitively enough means. But when we get to a point like this one on the chart, we move to an environment where Microsoft has broken above $27 a share here, and so it should be the next support, the next level of support. And it works that way for a long time. Actually, Microsoft gets all the way up to $36, $36.50. And so it seems that the chartists' belief that today's resistance becomes tomorrow's support makes sense, but then of course the stock gets eviscerated and drops all the way down to the mid-17s. And so this is an example of a rule set in technical analysis that kind of works until it doesn't. This is our daily chart for Microsoft. Now in April of 2014, the chart for Microsoft would have told us to get out. Okay, so it would have said, okay, you know, these candlesticks look very, very bearish. It looks like the thing's going to head a little bit lower, but if we did that, if we followed the rules of technical analysis, we would have missed the drive up to this point here on the chart. And so again, another example of where the chart tells us that the market's going to zag, but in fact it zigs. So again, it's an ambiguous example, and it's an example that tells us to sell, but it gives us bad advice in this case. Now let's look at the monthly for Johnson & Johnson. Here's the monthly chart for it. It seems that in, I think it's April of 2005, resistance hits at about $68.50 to $69 a share. We bounce up against that resistance frequently. Again in October of 2006, then again in December 2007. Then the resistance gets pierced when the stock climbs above $70 a share. That's right here. And that would tell us again that because today's resistance becomes tomorrow's support, we should buy in. This is an even more extreme example than Microsoft because we'd get deked out and the stock would drop again. We'd get eviscerated. The stock dropped back down to $48 after that so-called support became, or that so-called resistance became support. So again, another ambiguous signal from Johnson & Johnson. Looking at the daily for Johnson & Johnson, and I don't want to belabor the point, but here we have more evidence, quote unquote, that the stock's hitting a resistance in the mid-90s, somewhere between $94.27 and $95 a share in this period. Again, we hit that resistance here as well. And so if you were a trader based on using technical analysis, you'd want to get out in the mid-90s. You'd want to get out at about $95 a share. But if you did that, of course, you would miss the rise up to $106. Now, because that $95 a share resistance became the new support, would you get in at $106? Maybe you would, maybe you wouldn't. But if you did, it would drop you back down to 102, which may, going forward, may be support and maybe resistance. We don't know. So again, this is another example, and these are examples just off the top of my head. The technical analysis is a little bit ambiguous or sends us signals that we should be very, very careful of interpreting, and we should be very, very careful assuming that that history just repeats. That's a very naive perspective, and we should probably try to avoid it. I think the solution to the problem of technical analysis and fundamental analysis is something I've talked about at length on this channel. Just like with fundamental analysis, we run the risk of having a false narrative that leads us down a very unprofitable path. With technical analysis, we run the risk of having a false pattern, or we recognize a pattern where none actually exists. And so I think we can overcome these problems by, in terms of at least in stock investing, buying puts on our stocks, which keep our capital preserved as much as possible. And instead of actually buying stocks, we might actually only want to buy calls on stocks, because with calls we only have to put up a small fraction of the cost of the stock, as I've said on other parts of this channel. So that mathematically allows us to limit our risk, limit the capital that we put at risk, but keep our upside as unlimited as possible. And if we do that, we can overcome some of the problems inherent in fundamental analysis and technical analysis. It's a theme I've talked about at length on this channel so far, and I'm going to continue to do so. So, as usual, thank you very much for watching, and I look forward to comments and questions.